Hello and welcome to the UTI Swatantra series powered by ET Now. This is our ongoing year-long investor education initiative. Today we are in the beautiful city of Ludhiana. We're helping SMEs and young entrepreneurs, people who run the heart of this country really, to manage their finances better. I have a wonderful panel of guests on the panel with me. Iqbal Singh is the founder and managing director of Innovative Financial Management Private Limited. Hansraj Kapoor is the general manager with Nahar Capital and Financial Services Limited. And Deepak Pahwa is a leading IFA in Ludhiana. We also have a wonderful right now who's come in with questions to ask each of our guests. I want to start off with one quick answer from each of you, and I'll start with you, Deepak. When we're talking to the SME sector, and a lot of times we know now how entrepreneurs tend to put their heart and their soul into their business, and a lot of times all of their money as well. How important is it for them to set aside perhaps a little bit for themselves and for their own retirements?
It's a very valid question, but I personally think they are not thinking about that for their personal goals, for their child education, child marriage, and their retirement. Personally, they don't think about that. They are all think about their businesses. They are putting a lot of money in their business and putting time by time. And there is, if anything has happened, there is a lot of risk is there. There is a lot of things that happen time to time. If they start some money regularly, some of the saving from traditional, in financial product, from traditional savings to financial products, they can generate more returns.
Right. I want to ask you about an emergency fund. How important is it, especially if I'm running my own business? Because it's one thing if I have a salary and I know the salary is coming, month on month. But if I'm running my own business and I have a certain responsibility, there are EMIs, school fees, salaries that have to be paid. What sort of an emergency fund should I ideally have?
In India, like other foreign countries, US and Europe, we have lesser support from the government in our older age. So, like salaried people in India, usually every employer deduct some part of their salary from their account and deposit in a PF account or ESI or other health insurance. But for SME, I always recommended that everybody should have an emergency fund. They should definitely should open a PPF account, latest NPS account. Everybody, whosoever the individual is, and also out of their earning, like they want to spend in the household expenses, they should keep a money out of their monthly income separately for emergency, so that if they require for business or for health or for anything, definitely they should have a 5-6 months money for that purpose. I recommend every SME should keep some money aside like a emergency fund. Thank you.
Well, the interesting thing about keeping an emergency fund, one option is obviously to leave it in your bank account or to put it in a fixed deposit. But there are liquid funds that could function very well as emergency funds, aren't they?
Yes, first of all, definitely you have to create the emergency, or it is in a technical language, we'll say contingencies fund, emergency contingencies fund. So, what you have to do is at least, as a thumb rule, whatever is your household's, expenses on an annual basis, you keep at least 5 to 8 times, or up to, if you want to be on the safer side, 10 times of that has to be kept as a contingency fund. And we want that the contingency fund should also work and earn for you. So what we will suggest that, because it may be required or it may be called in case of any emergency, so those funds should be kept into efficient liquid fund or a short-term funds, where you can also get returns ranging between 7.5 to 8.5, depending upon the period you keep the money there. And that will also work, and that will add to your income apart from the SME income which you are getting, or which you are generating out of your business.
The concept of mutual funds as an investment, Deepak, I want to start with you. The fact that there are a lot of people who don't use mutual funds right now because of our affinity to physical assets, because we prefer a lot of times real estate and gold. I can actually touch it, I feel it, I know that it's there, I know it's in my locker. The whole concept of using a dematerialized investment, which is a piece of paper that says that you own something that you can't really physically touch and feel and know that it's there. What are the benefits of using a mutual fund vis-a-vis using physical assets like gold or real estate?
A lot of people in these days that look in city. I again say the city like Ludhiana, they go for a traditional investments. They go for a PPF, they go for a bank FD, they go for a small saving scheme where they will get a 8% return. And that is almost all the after a PPF, that is all taxable. And you will get 5 and 5.5% return if you get 10% tax or 20% tax in that. If you go for a mutual fund scheme, you will go for better returns. If you go for liquid funds, you will get a 8.5% return, go for up to 9%. And if you go for longer period, for 3-year period, you will go for a 12%, 11 to 12% return in last year. And if you go for stay for 3 years, you will get a tax-free returns. The money is go for a long-term capital gain. In a bank FD, you will pay 30% tax. But go for a debt fund, you will pay a long-term capital gain, which is almost free, almost tax-free after 3 years. That is a wonderful thing. And there is no risk at all. Almost there is no risk at all.
All right. We have some questions from what I understand. Yes, please stand up and tell us your name.
Before when you were discussing, you told me one thing, that you should have a systematic entry and a systematic exit. Can you tell me how should we calculate which is the proper time to invest and which is the proper time to exit? Do you know particularly the market now is undervalued or overvalued, and how it is going to behave in the future? So I would like to give the answer from you, that you said that systematic entry and systematic exit. What does it actually, how to calculate the systematic entry and exit?
So the whole point of a systematic entry is that you don't time the market. So you don't have to then worry about whether the market is overvalued or undervalued, or whether the market is going to go up or down, because you are going to average out that risk over a longer period of time.
That is the entry. And exit?
The exit depends on when you need the money. So if you know you are going to need that money on a goal-based format, where you know that I've invested this money for my daughter, for my son, for my retirement, whatever it is, and you are approaching that goal, 2-3 years before that goal arrives, you need to start removing your money in a systematic format. So you don't have to worry about timing the market at all.
Actually, there are the point is that you should not time the market. You should be in the market. That is the first point which he has shared. But secondly, I'm saying, there is in each and every industry, there are parameter of valuations, whether it is undervalued or overvalued. So I'm not going to elaborate those parameters, but you have to monitor those parameters. And those 3 parameters which is used worldwide across the globe, those are PE multiple, price to book, and dividend yield. These are the 3 parameters which will give you some idea whether the markets are overheated or undervalued. So you can definitely say whenever there is an exit or a goal, maybe 3 or 4 years down the line, you can also attach with that what is the valuation today in the market. So based on that, you can take a call.
I am Rajiv Jain. Continuing this process, like we were saying that we should have keep an idea of what is the goal we should keep 3 years, 4 years, 5 years. See, there was a crash when we were discussing about that. There was a crash in 2009, when 2008, that the Sensex went down. Sensex went from 22,000 down to 8,000 and stayed stagnant at 16,000. Then, see, we have invested our money in the market, which was surplus, one. When the Sensex crashes, the business also comes down. There's always a slump in the market. Then you need the money. So there's a crunch in the business. There's a crunch in the investment. So what should the person do in that situation when you need the money and you don't have the money in either in business nor in the sense, nor from your mutual funds. Either we book a loss, do we book a loss, or what do we do?
Do you want to take that, Deepak?
मैं आपको इस बात को एक सिंपल लैंग्वेज में समझाता हूँ. आपने खुद ही आप अपने क्वेश्चन का आंसर दे रहे हो. यू विल ऑलवेज पुट इनटू डाइवर्सिफाइड. आप हमेशा डाइवर्सिफाइड रहिए. आप अपना बिजनेस कीजिए, आप पैसा लैंड में लगाइए, आप पैसा गोल्ड में लगाइए, आप एफडी में रखिए, आप डेट फंड में रखिए, आप इक्विटी में लगाइए. जब आप अपना पैसे को सारा डाइवर्सिफाई करके रखते हैं तो आपको इस चीज़ का रिस्क नहीं आएगा. उस वक्त उस टाइम पे नहीं आएगा. आप इंडेक्स की बात कर रहे हैं. इंडेक्स 4000 था 2002 में. इंडेक्स 8000 हुआ, 21,000 से 8000 हुआ 2008 में. लेकिन आज इंडेक्स 28,000 है. इफ यू स्टिल इन्वेस्टेड, स्टे इन्वेस्टेड for consistently.
That is what I am saying. Business, and you're saying that take out your surplus money keeping in mind 3-4 months. That is what we were discussing out before. 3-4 months का आप contingency meet करके चलिए कि कल को हो सकता है. अब जब सेंसेक्स डाउन गया, डाउन नीचे आया, तो उसमें क्या होता है? बिजनेस ऑल्सो सफर्स. एंड देन बिजनेस में पैसा नहीं बनता, सेंसेक्स में इधर म्यूचुअल फंड में पैसा नहीं बनता, एंड वी नीड मनी. And what should we do? Either.
So you misunderstood us. The 3-4 months contingency fund will not be invested in the stock market. It will be put in a liquid fund where there is no risk at all. It will give you similar returns to a fixed deposit, and the risk is also similar to a fixed deposit. The long-term money that you're going to put aside for 10 years, for 15 years, for 20 years, that should find its way into the stock market.
Which means we should wait for that period to go ahead so that we get again good returns for that.
In 3 to 4 months, you can go for a liquid funds. Where you can get 8.5% return.
I think so. We have a communication gap. आपने ये कहा कि as an SME, मैं एक छोटा उद्यमी हूँ. मैं एक म्यूचुअल फंड में इन्वेस्टमेंट करना चाहता हूँ. मैं तब करूँगा जब मेरे पास एक्स्ट्रा मनी होगा. आई एम नॉट गोइंग टू पुल इट आउट फ्रॉम माई बिजनेस. मैंने एक पैसा इन्वेस्ट किया म्यूचुअल फंड में, keeping in mind long term, because what we say is minimum of 3 years should be kept in a mutual fund to get a good return. मैंने पैसा इन्वेस्ट पोस्ट कर दिया. At that time Sensex comes down, my morale goes down, business goes down. फिर उसमें मैंने क्या पूछा है कि उस सिनेरियो में हम क्या कर सकते हैं? Either we should be pull back, pull out of that, or what to do?
Hansraj, you haven't spoken at all. Yes, welcome to you.
In your specific example, if you have put money in 2005, then 2008 this trouble comes. Actually, this 3 years, these are the years when this index starts from 8,000, goes to 22,000, then again comes to 8,000. So, if 3-year perspective you have invested, 3,000 are 3,000, 8,000 are 8,000, number one. Number two, because if you are in equity market, definitely you already made your mind that I am ready to take some risk in the equity market. In such a situation, an ideal situation is that if you think it is come down due to some certain reasons which may or may not sustain in 6 months or 1 year. So the thing is, there is a banking system. You don't sell those your equity market. Go to bank, take 60%, 70% from them against as a less loan against security, and do your activity, necessary activities. Don't take that money on, because investing has a one principle: you should have a patience, especially in equity market. If you don't have a patience, you can never make your return. That's my answer.
So the less is given on which amount? The NAV, what, the lowest one NAV or the highest one? What
the
was
NAV
closing?
prevailing at that day.
I just want to add Kapoor's point. If you are investing, what you have to do is that you are saying that, okay, this money is committed for 3 years and you are not certain about the market and market has tanked. So what you have to do is you have to invest, put that money into liquid, and from there let it go into equity in a systematic transfer manner, rather than going in a lump sum in a one go. The whole amount, you put it into liquid. From liquid, you say that, okay, every month or every week or every fortnightly, this much amount, 10,000, 50,000, 20,000 should go into equity. So the concept of this is called rupee cost averaging. So you are not doing a timing, and none of us sitting on the dais can do the timing. So the point is, what we can do, we can always say, okay, I should do it in a systematic manner. I have this lump sum, kept it for long term. Let small portion of that should go into equity in next 3 months, in next 6 months, in next 9 months, so that you should not have a heart attack if the market crashes overnight.
Right. Also, sir, I'd like to point out, 3 years is not long term. Anything above 7 years is long term. And if we go back to what we were talking about setting goals. So if you set aside this money for long term, which means let's assume it's for your child, for when your child goes to college, and the market tanks, you don't have to worry about it because you know that you have another 7 years to go and you can wait. This is not the money, so you put the emergency money for your business in something else, not in a stock market related or a stock market linked investment.
Raj, I am a government contractor. I usually invest in FDs as I need bank guarantees for the project. Is there any product in your mutual fund that can help me in that?
You have to give as a margin money to banks, FDRs?
No, I invest in FDRs.
Okay.
On basis of that, they gave us performance guarantees.
Okay, okay. Yeah. So my answer is on a corporate side, because I am giving usually these guarantees. Number one, the bank which give the guarantees definitely ask that give me some percentage in the form of deposit to give you guarantee. Yeah, so mutual fund will not substitute here because it is a banker's requirement. Number one. Number two, if you want to give guarantee, you can give another security to bank that okay, I have these stocks, I have this property as a collateral for your guarantee, you free my money. Because instead of fixed deposits where you have to give a tax of 33%, you go for a 1 year arbitrage fund or 3 years debt funds where you can get a tax-free 9% return. So that is an alternative. That's all.
Banks will issue me guarantee on basis of that.
Number one, your banker should agree that whether they will, instead of this collateral as fixed deposits, whether you accept your property or any other security as a collateral. If they accept collateral for issuing bank guarantee, then your FD is free. There is no logic into keep your money in low return FDRs.
Do we have an assured sum that we get out of after a certain period of time? If we invest into mutual fund for say 10 years, so is there any sum assured that at least we will be subject to a limited risk? So is that something like that?
Yes. There is a FMP, fixed maturity plans in mutual funds. That is for, if you can invest for 3 years, they will give you a 9% return for these days. 8.5 to 9% interest return for these days, and that is almost assured.
So that is the assured.
Then there is no risk at all. And you will get a long-term capital gain benefit after 3 years. That is, after all, it is tax-free after 3 years. Okay. If you can go for bank FD, you will pay 20% or 30% tax according to your tax bracket. You can go for FMP. Almost fixed return up to 9% for 3 years, and you will get it almost tax-free returns.
Okay. And when we talk about contingencies, when we talk about emergencies, and we say that we want to avail that money in case we have an emergency, so at that time how easily can we get our funds? Like
there is two things. Yeah. You can loan against FMP, that is 85 to 90% from any bank.
No, how easily and how?
Would be a terrible contingency because you can't.
And then go for liquid fund.
Okay.
You can put some money in liquid funds where you will get 8.5% return. Okay. And you will withdraw in any day.
We can withdraw it any
easily
day.
withdraw.
Okay. That is what my point
You will
was.
get it the next day. If you can talk about Monday, you can.
Actually, could you tell us what the process is? Assume I have put my emergency or contingency fund in a liquid fund. I need to withdraw it today. What is the process to withdraw?
It's very simple. You can sign one single form. You can in our office or in a mutual fund, in any office, in mutual fund office, you can get a next day payment in your account. Next day, 10 o'clock, you will get the payment in your account.
Thank you so very much.
I have a question for you, sir. If I make a seasonal income, there are period whole year, on 4 months I get more money, rest of the time I don't get money to invest. How to invest in mutual fund industry? Is there some plan for that? Seasonal income के according मतलब expenses तो 12 months चलेंगे.
So basically, if he's getting only seasonal income at certain times of the year, how should he invest that money?
Yeah, actually I have already explained that in mutual industry there are so many instruments available for your needs. If you have surplus money for 1 day, 30 days, for a quarter or 6 months, product is there. There are 3 months quarterly fixed maturity plans, 6 monthly plans also. And if you are uncertain, I don't know when I will need the money, the better keep it in a short-term fund or liquid fund. So money will earn you the income at a 7.5% to 8%, and whenever you will require, it will be yours. So that is the best thing.
Before we wrap up, I want one closing note from each of our panelists. Given the kind of questions we've heard today, there seems to be a lot of nervousness about the stock market, that I might invest today, the stock market might fall tomorrow, I might invest for 10 years and then just when I'm ready to take that money out, the stock market might crash again. Words of reassurance on how A, using a diversified equity fund, B, using the expertise of a fund manager to manage my money, how these two things can mitigate the risk of the stock market. Will you start with Vijay?
First, there is a lot of funds. There is a lot of fund in India now. There is a 15 to 20 year track record. If you go for any diversified fund, you will see the returns will be 15 to 20% in next 15 to 20 years. And you can create a lot of wealth creation. And when you talk about in India, there is no social security system. So you can save little more for your family, for your children, you have to. And one more thing, after health insurance, you can go for term insurance also, where you can get a family, where you can go for a risk coverage. You can pay 20 to 25,000 premium for 1 crore. If anything has happened, your family will get that amount.
Gentlemen, there are so many funds in our mutual fund industry, which itself handles your this worry. Like balance funds, flexi funds are there, which automatically, as per fund manager's expertise, switch from equity to debt whenever they feel. Because though Mr. Iqbal has told that these are some parameters like price to earning, price to book value, and so many other sensitive levels you can analyze yourself. But it is not possible to analyze these, and we have fund managers sitting in the mutual funds handling lakhs of crores of rupees. Use their expertise. If you are uncertain, you don't want to risk in the equity market, go for these balance funds, which automatically adjust between these fixed deposits and your equity market. When equity market falls, they raise their equity exposure. When equity market is down, they reduce their exposure to equity market and go for fixed deposit. So it is though you will not get 100% return out of equity market, but you have a great safety there, and your money will never be gone like gone in a single equity market and Sensex farm from 21,000 to 8,000. That is my one way of solving this problem.
Right, balanced funds are actually a very good way to go. Balji?
Yeah, the most important thing which I personally feel that one has to see the consistency of the fund. That is the key thing when you are investing. The point is that, and at the same time now, most of the fund manager has also made their name in terms of managing the money from consistently from so many years. So the most important thing is that whenever you are investing, you have to see the longevity of the fund and how consistent that particular fund has delivered you the results and return. That is the key thing, where you can mitigate your risk. But whatever is most important factor which you have to consider is the track record of the fund manager as well as the consistency of the scheme. That is the bottom line in terms of how that particular fund has delivered you the return. And at the same time, that will also reduces your risk. And if you are a first time investor, definitely you have to do your own profiling, which is very, very important. And once you do that, your profiling that I don't want to take a risk with my capital at all, don't venture into equity at all.
We thank all of you for coming and spending time with us this evening. You've been a wonderful audience and we've enjoyed answering your questions, and I'd like to thank the panelists for coming in as well. You've been great. If you're watching at home, remember we might very soon be in your city. So if you'd like to join us, all you have to do is log on to indiainvestkaro.com or leave us a question on Twitter, #InvestKaro. Thank you so much for watching.